What's up traders, Tom here with another video. Today we will be discussing buying pullbacks in the stock market. But with a market that it seems to be going up every single day, that might seem hard. Is there any good news for dip buyers coming? Stay tuned. Now, if you're probably watching this video, chances are you didn't buy enough stocks at the low and you're now possibly regretting it. If you're watching this video and you bought as much as you could get, well done to you. And possibly you might even be looking for more. Let's now take a look at some interesting facts about these types of V-shape or U-shape reversals that we're seeing on indices right now and why buying the dip in the future might be actually possible. So I have a bit of a theory, and I'll call it elevator theory, and it's based on, of course, many people's comments in the past. And it is that if you walked into an elevator twice in a few days and you overheard people talking about a specific stock or the stock market in general, then you need to be cautious and risk averse when it comes to investing your money, specifically if it's about a stock. So I'll tell you a quick story before we get into the rest of the video, and it's about a stock here in Australia. Many years ago, everyone was talking about Commonwealth Bank. That's the biggest bank stock here in Australia. And everybody was talking about how that stock was going to be one of the first in our index to reach $100. I think it was trading around $96 at the time. So everyone was talking about it. Everyone was buying these stocks. And what happened over the next coming weeks? They did dip. Did they crash? No, they didn't. But they certainly dipped down and they fell off their incredibly high valuations and came down over time. Now, obviously, we're in a different situation where the Fed is controlling the entire stock market, and to a degree, it has done its job. And I do also believe that, as based on the video I did the other day, the Fed has an incredible amount of firepower left in their reserves. So let's talk now today about the current situation and whether a dip may be coming. So I'll start by talking about Hertz. We mentioned Hertz the other day. We mentioned how Carl Icahn sold all of his Hertz at something like 76 cents a share. But now people are speculating that this potentially bankrupt company, or is bankrupt company, is going to be good in the future. And what's the price action been doing? Well, it's moved from that 76, even down as low as kind of 40 cents, all the way up to $4. So depending on where you bought this share, you were looking at hundreds and hundreds of percent of returns in only a few days. Remember, this is a 2-hour chart. So speculation is rife. And why is that? A huge amount of retail traders are entering the market and they are buying these kind of stocks with their ears pinned back. Basically, look at these top 100 stocks. We have some quality in here, and then we have some severe speculation. We have Delta Airlines, Carnival, American Airlines. So there's a lot of speculation coming in now that the economy is reopening. Delta is, of course, coming off a base, and based on over time, it is relatively cheap, but there are still problems with it. And it has moved up significantly over the last week. So I'll bring you to this quote by Richard Thaler. And he basically was asked a question about what he thought about this current stock market rally. And he said, it could be just that people have a lot of time on their hands. Or one friend suggested to me that it's possibly replacing gambling. The casinos are closed and there are no sports to bet on. So people in the comments section were actually talking about, is there so many retail traders in the market right now that it makes a difference? There certainly is a huge amount. And I do believe, like any rally, that you will see a dip to potentially clean up some of these people that are in the market. Remember, so many people have just been getting into the market for the first time ever. So what's happening with put-call ratios? Put-call ratios have been covering a little bit. They are still going low. We want to see this for consecutive days. If the market continues to go up and put-call ratios are low, that is a bit of a bearish sign, because whenever no one expects something, something will happen in the markets. So keep a lookout for put-call ratios. Of course, we had the unemployment figures in terms of the non-farms. It turns out that the real unemployment rate might be less than expected at around 13%. Is that amazing? Well, we can see on this chart here, these are all of the unemployment figures over time. This was the GFC. This was the kind of rise. We are still well below that, but we have Jerome Powell and his printing press helping us to get to all new highs. So we'll just quickly talk about the second wave, if that's even a thing that the stock market cares about anymore. But with all of these current rallies going on around America, could it be that a lot more spreading could be happening? Yeah, it's definitely possible and something to consider. So let's now talk about dips and how to spot them. Well, here we have the S&P 500, and it is certainly looking very V-shaped after that unemployment figure on Friday. We've hit 3,200, which was the next case for resistance. Remember, Goldman Sachs said 3,200 was the absolute peak, and that's where they've set their 12-month target at. So we're at the 12-month target, but we have at least, around 6 more months to go. So what could be happening here? Well, generally speaking, when markets go up, they usually have dips or pullbacks for you to get in on. Let's have a look at this actual pullback that happened over in December into January. So this was actually a V-shaped reversal. We had a full sell-off followed by an incredible rally. But there was a pullback after that rally. Now the rally happened at the top. So it actually made a slightly new high and then it pulled back. And that's pretty normal for what markets do. What I want to draw your attention to though is the way that it pulls back. So it pulls back to a 38.2 fib of the entire move. And this is quite standard. In fact, in our course that we teach, I love 38.2 and 50 fibs. They are my favorite fibs and they're really the main fibs that I use. I know a lot of people use 61.8 and all of those reasons why, but when you understand the psychology of the market, it's actually better that markets come back to 38.2 and 50 and you're buying that dip rather than it goes too deep. And you often miss out if you expect it to come down too much. So let's assume that we all believe that the Fed can completely hold the market up and that the market will continue long. Well, 38.2 fib off the previous peak was where the dip happened and the opportunity to get involved in that market at least some form of discount. If we go back more history and we think of more V-shaped reversals, we can now have a look at this one here and we can get the V-shape here. So this one actually went down, it made a double bottom. And that double bottom then moved up. And then of course it sold off, came back, sold off, hit a 38.2 fib. And then there was absolutely no looking back. So another pretty decent pullback followed by a nice Fibonacci 38.2 for the pickup where the market got in and then they got more. Remember, it's a good chance that Wall Street didn't get as much volume as they wanted. Did they get into enough stocks that they wanted? Did they dump stocks and not get everything they want? It's a good chance, and they will flush out the retail traders to collect the stocks that they want going long. Am I saying that we're going to go down and crash and get a 40%? It seems unlikely purely because the game has changed due to quantitative easing at extreme levels. And in previous videos, we've talked about how it looks like the Fed and other world countries are all basically in a currency war with each other. And it looks like the Fed is just going to be able to print as much money as they kind of want against asset purchases. And they're going to do that. And they're going to do it like Japan did. So they've got a bit more in the tank, that's for sure. So even markets that go up, let's say to all-time highs, where there's a correction, you think you've missed out and it comes up, usually it will return back down. So let's take a Fibonacci of this one as well, just to look at more than just one of them. So again, it's come down to the 38.2 of the entire move. So I think you're starting to see a bit of a concept here, a bit of an idea. Generally, when markets go up and they do very big V-shaped kind of moves, they usually try to do around a 38.2 fib pullback. No surprise again, big rally, 38.2 fib pullback, no return. And these are on big rallies. These are the rallies that are most recent, so you have to look at these. So I think you're probably getting a bit of an idea of what we're talking about. We're talking about fib dip replacements coming off the entire move, and there's a good chance there'll be that kind of flush out based on the kind of action that we're seeing in speculative stocks and that we're seeing in the retail crowd. Wall Street usually likes to punish these people, and we've talked about that with sentiment and everything else. So if the market was to pull back off this point here, we would see the market come back to around 28.17, 28.20, and then that to be the 38.2. But what if it goes on and makes an all-time high again, or at least around the equal high? So that's like the worst case scenario if you are not in and you're looking for pullbacks. Well, the good news is that a dip would still be coming back to 29.20, and that would still allow you to potentially get into the action for the longer term. Could there also be some bearish action coming? There absolutely could be. So if you were to think about where logically the market's aiming for, it kind of looks like it's strangely aiming to go hit a high, pull back, resistance becomes support, and then it moves on. And if that is what Wall Street does, well, they've done a very good job of flushing out many traders, because many traders will be looking at this thinking it's a second crash, and there will be buying support here from Wall Street. Just because previous resistance will become support, and as many people are talking about, the really, really bad news is becoming less bad. And that concept is what drives this kind of liquidity flow and this kind of optimism. And we have already seen this is not about unemployment. It's not about the real economy. We are in a paradigm shift. All the stock market cares about is profit at the end of the day. And it looks like they're going to make tons of profit in the big companies because they can have cheap labor. They can have tax breaks, they have unlimited liquidity, and they're all good and all safe. And unfortunately, while the general population is not going to do well, they are going to make bumper profits. And we've also spoken about, and I'll be doing another video on this, so make sure you subscribe and hit that bell, that current PE ratios will never be the same again after this printing of money. They will never be the same again. You are not going to see 15, 16 PE. We've already had the case study from the previous quantitative easing, and it's going to get worse. So if you've liked today's video, make sure to give it a thumbs up. Comment down below with some other videos that you'd like to see. I'm always jotting them down and trying to answer as many people's questions as possible. And of course, if you're feeling that FOMO and you have to get in, look for sectors that still have some sort of value in them. And I'm not necessarily saying that's in airlines. I actually don't like airline stocks. I think they have so many risks. I hate just this idea that one's flying and then it just suddenly crashes and then you lose 20% of your value. So I did a video on McDonald's the other day and I said, well, that was a pretty defensive stock all around during crashes as well. So that is an opportunity. There are others out there. Are they the cheapest they've ever been? No. Are they decent value? They're okay for the long term. So there are some value, but the value is obviously not going to be in the tech stocks right now. Those ones you will be paying high money for. See everybody, and happy trading.